every transfer window, you hear the same phrase repeated across European sports media. Turkey is a tax haven for professional athletes. Top-tier football, basketball, and volleyball players constantly make the move, arriving to massive fanfare. This chart compares the top marginal tax rates for athletes in Europe. While many Western European nations take close to half of a player's salary, the Turkish system applies a withholding tax capped at exactly 20% for the highest leagues. Turkish clubs reinforce this appeal by offering net pay contracts. They promise the athlete a guaranteed take-home amount and agree to cover the entire tax bill on the club's behalf. However, labeling Turkey a tax haven misinterprets the specific mechanics of the country's tax code. That flat 20% withholding rate is temporary. If an athlete's earnings cross a specific statutory threshold, set at 4.3 million Turkish lira for 2025, that initial rate is voided and a series of complex legal mechanisms takes over. Crossing that income threshold triggers a massive progressive tax liability. Legally, the burden of that debt falls squarely on the individual player, regardless of what their contract says. The entire scope of a player's financial obligation hinges on a single legal concept in Turkish law, mukimlik. Mukimlik is the legal status of being a resident, and it is the primary trigger that defines how the state views an athlete's wealth. The system captures players through routine administrative paperwork. To play professionally in Turkey, a foreign athlete must obtain a standard work permit. To secure that permit, the government requires them to register a physical residential address. This diagram shows the legal pipeline. When an athlete registers an apartment lease, Turkish law classifies them as a full taxpayer. Even without an address, spending over 183 days inside the country forces the exact same full taxpayer status. The only individuals who escape this classification are those arriving for brief stays, like a short summer tournament or a strict half-season loan deal without a permanent residence. The mandatory steps required to live and play a standard season in Turkey rewrite an athlete's global tax profile. This gauge shows the financial impact of full taxpayer status. Once income clears the 4.3 million lira mark, the athlete is forced to file a personal annual tax return, and the tax rate jumps from the standard 20% up to 40%. The tax authority defines wages broadly, including match bonuses, signing fees, performance payouts, and in-kind benefits. Adding these extras ensures that virtually every top-flight foreign player clears the 4.3 million lira threshold. The club will likely wire the extra funds to cover that 40% bracket, as promised in the net pay contract. However, the legal responsibility to accurately file the return and the risk of severe financial penalties rest entirely on the athlete. Secondary income streams add another layer of complexity. Any promotional deals or sponsorships organized directly through the team are legally categorized as standard wages, pushing the player's tax bracket even higher. This heavily contrasts with completely independent brand deals. When athletes sign personal endorsement contracts without setting up a formal corporate licensing structure to lease their image rights, the money they receive is treated differently. The state classifies these independent deals as commercial income. Earning commercial income means the athlete is legally required to register as a sole proprietorship, maintain formal accounting books, and submit quarterly tax filings. A player's high profile and lucrative off-field success directly multiply their administrative workload, forcing them to simultaneously manage multiple distinct tax classifications. Securing full taxpayer status triggers a significant expansion of the state's reach. The government gains the legal right to tax the athlete's global passive income. This map illustrates the expanding Turkish tax net. Global rental income, foreign stock dividends, and international bank interest are pulled into Turkey. Because sporting wages fill lower brackets, every dollar of foreign investment return is immediately taxed at 40%. What began as a decision to play a few seasons in Istanbul has legally compromised the player's international financial portfolio. There is a legal mechanism to fight back against this global net: international double taxation treaties and their tiebreaker rule. A double taxation treaty is an agreement between two countries designed to prevent the same income from being taxed twice. When two nations both claim an individual as a resident, the tiebreaker rule determines the true taxing authority by locating the athlete's center of vital interests, the specific country where their economic and personal ties are actually the strongest. Because top players physically relocate their families to Turkish cities and draw the vast majority of their wealth from a Turkish club, the local authorities almost always win the tiebreaker. Protecting overseas wealth requires rigorous global tax planning. Athletes must claim foreign tax credits, proof they have already paid taxes, in another jurisdiction. Otherwise, they will be taxed twice on the same income. The Turkish sports economy operates within a sophisticated legal environment. Relying on handshake net pay agreements and ignoring the fine print will result in failure without a comprehensive international legal strategy from day one.